this is 12.1. It's about gross domestic product. And gross domestic product is basically just like the number of all the goods and services produced in a given year. And what this does is it uses national income accountings to monitor like how the U.S. economy is doing. And all the bold, by the way, is all the vocab. The national income accounting collects and organizes macroeconomic statistics on production, income, investment, and savings. And after this, the Department of Commerce presents this data in the form of national income and product counts, which is NIPA. So for defining GDP, like I just said, it's the dollar value of all final goods and services produced within a country's border in a given year. So there's some characteristics to this, which will be explained. One of them is the dollar value, which it refers to the total cash value of the sales of all goods and services produced in a country's households, firms, and governments in a year. The cash figures are used to calculate the GDP. And okay, since there's like different quantities of goods, like say like there's oranges and computers, they're all sold at like different prices. So the economists figure out the average prices of these items and total the number sold during the year. For the final goods and services, they're products in the form sold to customers, and one of them is intermediate goods, which are products used in the production of final goods. Another characteristic is if it's produced within a country's border, and you can only look at the goods and services produced within that country to calculate the accurate GDP. And if it's in a given year. So it takes into account when a good was produced. So say like your neighbor sells his used car, and when the car was originally made, it was counted in the GDP of that year, not like later on years. The expenditure approach is one of the methods that they use, and it's sometimes called the output expenditure approach. And it estimates annual expenditures, which is the amount spent on four categories of final goods and services. So these four categories are consumer goods and services, and there's two kinds of goods, durable and non-durable. And durable is like they last for a long time, while non-durable don't. Durable goods would be like a refrigerator, and non-durable would be like food or like tennies because they go out of date. Business goods and services is the second one. Government goods and services is third, and net exports, which is found by adding up exports and subtracting the imports. The income approach is the second method that they can use, and it calculates the GDP by adding up all the incomes in the economy. And like in theory, calculating all this with both approaches, it should give the same total, but sometimes it's a little off, so they have to like alter it. But usually there are differences because of errors in the underlying data, and they determine it with both. But usually they have to make the adjustments to offset the differences that they get. For how do you say this? Nominal GDP. It's measured in current prices, and this is also the current GDP. And how they calculate this is they just use the current year's prices to find the value of the current year's output. Real GDP, on the other hand, is expressed in constant or unchanging prices. So for this, economists can discover whether an economy is actually producing more goods and services. And regardless of the changes of prices in those items, you can still find them. So for the limitations of GDP, it doesn't take into account certain economic activities or aspects of life. And there's 4 things that will be discussed, which is non-market activities, underground economy, negative externalities, and the quality of life. So non-market activities, this would be things like babysitting or like mowing lawns, where it's not, it's where people pay others to do work like that, but it doesn't technically count because it's not like a business doing it. The underground economy is like the black market, and a large amount of production and income is never recorded or reported in the government. It's like the black market. The government really doesn't have any control of what happens and what's sold. Also, under the table wages to avoid paying business and income taxes is another example of this. Many legal informal transactions are also not reported. Like, say you sold a bike to your friend, that would technically count. Or like shoveling snow, babysitting could count. Negative externalities, unintended economic side effects have monetary value that often doesn't reflect in GDP. So this would be like a power plant. They emit a lot of smoke and dust and are bad for the environment, but these negative results aren't subtracted from the GDP. The quality of life is the last one, and people interpret like rising GDP as a sign of rising well-being, but this technically isn't like true. Additional goods and services do not necessarily make people any happier. Some things that are not counted in GDP contribute greatly to people and the quality of life. So this would be like your surroundings, what you do with your free time, and like your personal safety. This is why GDP is like somewhat flawed with this aspect. So other output and income measures. GDP is used to determine 5 other economic measures. Gross national product, which is the annual income earned by a nation's firms and citizens. And this is measured of the market value of all goods and services produced by Americans in 1 year. And it doesn't account for the depreciation. And another thing is the net national product is the gross national product minus the cost of depreciation of capital equipment. And what this does is it measures net output for 1 year. The third characteristic or measure is the national income, which comes from making minor adjustments, and they find out how much pre-tax income businesses pay to U.S. households. So the fourth one is personal income, which is like the remains of what people make from that. And disposable personal income finds out how much people have to spend after they have paid all their taxes. The influences on GDP. So what's going to be discussed, like what influences GDP, and in a real economy, what factors can make it go up or down. The 3 main factors of macroeconomics are aggregate supply, is that how you say it? Aggregate demand, and the equilibrium between the 2. So with aggregate supply, it's basically like a supply graph, like it's kind of the same thing. But to find it, you have to add up the total supply of goods and services that are produced for our product for sale in the economy. And this is how they find the GDP. And the price level of that is calculated. And the price level is the average of all prices in that economy. So after that, they determine the aggregate supply, which is the total amount of goods and services in the economy available at all possible price levels. So basically, as the price level rises, real GDP or aggregate supply rises. And as it falls, so does the real GDP. With aggregate demand, it's the amount of goods and services in the economy that will be purchased at all possible price levels. as the price level's lower, people purchase like more because it's cheaper. And falling prices increase wealth and demand. So with this, the dollars that we hold are worth more at lower price levels than at higher price levels because of how it works, I guess, I don't know. And then as price level rises, people buy less because it's more expensive and people don't want to spend much money on certain things. And this causes a reduction in the quantity of goods and services demanded. So for the equilibrium, it's basically just a combine of the two graphs, and it's where they meet in the middle, like for their demand and their supply. So it basically goes back to the demand and supply graph. But any shift in the causes the real GDP to change. So it just depends on if the supply changes or if the demand changes.